I think Keynes sort of struck a Faustian bargain with capitalism, like Marx did in a way. Capitalism is necessary to bring us out of the tunnel of necessity into the sunlight of abundance. That's a phrase. That's a phrase from the Economic Possibilities for Our Grandchildren.
When we get to the state of abundance, we shall be able to rid ourselves of many of the pseudo-moral principles which have hag-ridden us. I'm sorry, there's political incorrectness. Hag-ridden us, by which we have exalted some of the most distasteful of human qualities into the highest virtues. We shall be able to assess the money motive at its true value. The love of money as a possession, as distinguished from the love of money as a means to the enjoyment and realities of life, will be recognized for what it is, a somewhat disgusting morbidity, one of those semi-criminal, semi-pathological tendencies which one hands over with a shudder to specialists in mental disease. But that's when we've solved the problem. But beware, the time for all this is not yet. For at least another 100 years, we must pretend that fair is foul and foul is fair, for foul is useful and fair is not. Avarice and usury and precaution must be our gods for a little longer, for only they can lead us out of the tunnel of necessity into daylight.
I think the other thing which is very interesting about Keynes's utopia is that it has some resemblance to Marx's utopia. It's a utopia after capitalism rather than outside capitalism as the traditional utopias were. Because the whole of economics is based on the notion of scarcity. And all its axioms, optimizing individuals and stable preferences and all these things are actually based, especially the first one, on scarcity, the scarcity axiom.
Theories of international trade depend fundamentally on that for their conclusions.
So what happens when scarcity is no longer the most important driver of human behavior or economic behavior? And this was the subject of a fascinating little essay Keynes wrote, which I think has inspired me. It's inspired me quite a bit, called Economic Possibilities for Our Grandchildren. And I'm actually writing a book together with my son at the moment, who's a philosopher, called How Much is Enough? Economics and the Good Life, which takes up the question Keynes raised, what is wealth for? Looks at his predictions, which were that in 100 years, the developed part of the world would have solved the economic problem. It would have a standard of life which was 4 to 8 times as great as it was when he wrote that thing in 1930 because of increases in productivity and capital growth and so on. And then people wouldn't have to work, or they'd have to work very, very much less. And therefore they'd take out increasing amount of their productivity gains in leisure. Well, that has happened to some extent, but not nearly as much as Keynes thought it would. And in fact, in the United States, after a long, prolonged period of a fall in hours work, from about 1980s, they started going up again. They fell to just over 2,000. And then they've gone up again. And that is a puzzle. Why have people gone on working more than they need to for the abundance which apparently they have? And why do societies differ in this? Because the Dutch only work 5/8 of the time the Americans work. And their standard of living isn't very much lower, or hardly, very, very, very little lower. But they've taken more out in leisure. Americans want more consumption. Why is that? I think Keynes understood that there were relative wants and that some wants were relative, but he thought absolute wants would trump the relative wants, and that at a certain point competition would be very much more restricted than it is in conditions of scarcity. I would single out 2. First of all, markets are not very stable. They're liable to crash, especially that's true of investment markets. And secondly, when they do, and as a result of their crashing economies run down, the governments have a duty to provide a stimulus in order to break the fall and to promote recovery, because the markets won't do that themselves. So I think those are two basic features of Keynesian economics. That distinction between the psychology of the saver and the psychology of the investor is very closely connected with Keynes's distinction between risk and uncertainty. He did not think that the future was always merely risky, in the sense that it was like betting on things happening and being able to put numbers. In other words, having a set of probabilities about what would happen. He thought that a lot of it, and particularly when you were doing long-term investment, was unknown. You just didn't know what was going to happen. Of course, you invented various ways of dealing with that, but you didn't know. And therefore, he thought of uncertainty as being a very, very dominant impulse in human behavior, dominant motive for human behavior. And when the future is uncertain, in that sense, he thought that a lot of saving would be directed towards getting more security in the present, rather than building wealth in the future, which was the classical view. You saved in order to invest, in order to consume more later on. Keynes thought of saving much more as a kind of hoarding, or rather what he had called the propensity to hoard, or liquidity preference, would normally be stronger than the inducement to invest. And so that's the way he separated them out, via this crucial category of uncertainty. If you have no uncertainty, then of course the classical economics is true, and also a lot of modern financial economics. You have no uncertainty, you don't need, you have no problem of liquidity, you don't need to keep cash. Money has no utility in a certain world, whereas in an uncertain world it has a great deal of utility. As we have to act, we have to take views, and to say I don't know isn't really the basis for a decision. Unless we just act on caprice, but I mean, investors expect more than that. And so what people selling securities and anything else is, they do insurance policies, whatever, they invent numbers. Now, they're not inventing them in some sense of trying to cheat, but they are saying, well, let's start with some estimates. In other words, through something like using Bayes' theorem, we'll bet that it'll be like this, and then we look for evidence that confirms that. And so in a way they're trying to work out some risk premia that have some correspondence with actual risks, but they can't go very far that way. Along those lines, because the actual correspondence isn't really there in a lot of cases. So once people stop believing in these stories, then the crash can come very, very quickly. They believe that house prices are correctly priced for some time, and then suddenly they realize that there's no real basis for that. But what is the correct price? We don't know that either. It's just that everything swings. People suddenly cancel all their existing bets and want to get out. Now, none of that behavior seems to me to be explicable unless you have uncertainty there. And it's economics should start, I think, with the assumption that a lot of economic life is going to be uncertain. And therefore, what kind of economics and economic modeling and economic theory follows from that? we can certainly have an imbalance ex ante before the event, because in his equilibrium model, saving and investment are always equal by definition. But that's realized saving and investment. But before, as you're coming into your crisis, then there is an imbalance. People want to save more than others want to invest, and then he says, well, look. In classical theory, the theory he was combating, the theory of his day, what happens in that situation is the rate of interest moves immediately to adjust these two, this discrepancy, this ex-ante discrepancy, so that in fact everything proceeds smoothly, and investment and savings flow into investment smoothly. Whereas Keynes says, no, the rate of interest doesn't do this, because the rate of interest, what it equalizes is the desire to hoard money with the supply of money, so that it can remain above what's necessary. It doesn't fall by as much as is necessary to equalize saving and investment. And so, in a way, that self-adjusting mechanism, which classical economics had assumed to exist, wasn't there. I know that's a bit technical, but all it means is that the government has to intervene at that point, that there's no automatic mechanism in a market system that reconciles the desire to save and the desire to invest. And therefore the government has to sort of do something, or the Federal Reserve, the Fed or the central bank or whatever, it has to intervene. Absolutely. I mean, it has to create enough investment, I would put it this way, for the economy not to suffer from a fall in aggregate demand. Because if you have a fall in the savings function relative to what people want to save, you then start having spending falling off, because that sort of portion of spending that is going to investment has decreased.
Now going back to the Archbishop. In a recent essay, he called for a proper discussion of what wealth is for. Why is growth seen as the Holy Grail? Economics, he says, claims to have unearthed a particular theory of law of motivation which trumps everything else, that of self-interest. Rational self-interest underlies Adam Smith's invisible hand. But economic exchange, and then I'm quoting the Archbishop, is only one of the things that people do. And that's a very important phrase that he uses, only one of the things that people do. And then he says, why are we here? And he says it's to lead good and admirable lives. And the quest for wealth has only a limited connection with that. Moreover, maximization of wealth also calls for qualities which are the reverse of what is needed for goodness. So we must recover the courage to speak about these things, to speak about wealth and the pursuit of wealth in a moral and ethical framework. Now, both Smith and Keynes did that. I mean, with Smith, for him, economic life wasn't just one of the things we do. It was the main thing we do. And it's the main thing we do because of the universal condition of scarcity, what he called indigence. And so basically self-interest was something that was prime because it helped us solve this problem of self-interest. It wasn't just self-interest, there was also what he called sympathy. But indigence and necessity are the spur for improvement. Saving or parsimony comes to us from the womb. Self-interest is the motor of improvement, and it produces private property, which is the basis of the accumulation of capital and the division of labor. But it also, produces other things, commerce and the arts of exchange. come out of the quest for wealth. They make men sociable, and sociability is the basis of morality. Anyway, so you get this base superstructure sort of idea in Smith with self-interest as at the base, as necessary to get people out of poverty. Thus, the progress in civilization depends on progress in opulence. Opulence is produced by self-interest mediated by sympathy. Self-interest is innate, but sympathy is learned from the experience of living with other people. Now, interestingly, Smith didn't tell us what he thought life would be like after opulence was reached. I think he probably did have his utopia, but he did believe that it was the material progress of mankind which created intellectual and aesthetic appetites. So we must assume that Smith thought that one day economic life would simply become one of the things we do, as the Archbishop said, but it hadn't yet, that stage hadn't yet been reached. Now to Keynes, and I just want to take one strand of Keynes here, which is something I've been thinking about and working about recently, and that's his little essay, Economic Possibilities for Our Grandchildren. Keynes did speculate on what life would or should be when we'd reached a state of abundance. And he thought we were very close to it. This was written in 1930. His premise was that capital growth and improvements in technology were putting us within sight of solving the economic problem, at least in the West. A standard of living 8 times as high as in 1930 would be achievable within 100 years with a fraction of the effort, with the fraction of the hours that people then worked. Most work, in other words, would be done by machines. And so we would soon be in a position to abandon the morality born of scarcity. In other words, Smith's morality. With the economic problem solved, the Gradgrinds of the world will yield their places, and I quote Keynes, to the delightful people who are capable of taking direct enjoyment in things, the lilies of the field who toil not, neither do they spin. And significantly, Keynes said that once this point had been reached, we would be free to adopt the sure and certain principles of religion and traditional virtue. In other words, self-interest would be irrelevant at that point. In an era of abundance, like justice, self-interest would no longer make sense. And so the whole basis of our institutions would have to be transformed, and we would all suffer a nervous breakdown. Society as a whole. Now, in a sense, you might say, well, Keynes was simply following on from Adam Smith, only he was 150 years later, and the world had just become much more opulent than it was in Adam Smith's day. But there was one enormous difference from Adam Smith. Keynes did not see capitalism as benign, only as necessary. He was much more influenced by Mandeville and his fable of the bees. Mandeville's account of capitalism as a system which hypocritically turned vices into virtues. And he had little sympathy for Adam Smith's attempt to soften self-interest by the notion of sympathy. He would have agreed with Smith's contemporary Thomas Reid, who called Smith's philosophy of sympathy a delusive device for wrapping up selfishness in impartiality. So for Keynes, capitalism's only redeeming feature was that it got us to abundance. And for that we had to pay a very heavy price. And I just want to end here with a quotation from the Economic Possibilities for Our Grandchildren, which do show Keynes in his full flow and also reveal a great deal of the eloquence of his writing. When we get to the state of abundance, we shall be able to rid ourselves of many of the pseudo-moral principles which have hag-ridden us. I'm sorry, there's political incorrectness. Hag-ridden us. By which we have exalted some of the most distasteful of human qualities into the highest virtues. We shall be able to assess the money motive at its true value. The love of money as a possession, as distinguished from the love of money as a means to the enjoyment and realities of life, will be recognized for what it is, a somewhat disgusting morbidity, one of those semi-criminal, semi-pathological tendencies which one hands over with a shudder to specialists in mental disease. But that's when we've solved the problem. But beware, the time for all this is not yet. For at least another 100 years, we must pretend that fair is foul and foul is fair. For foul is useful and fair is not. Avarice and usury and precaution must be our gods for a little longer, for only they can lead us out of the tunnel of necessity into daylight. So that's Keynes on capitalism, the function of capitalism. Now, the Archbishop, Smith, Keynes, agree that wealth is simply a means to a good life and that its pursuit should cease after abundance has been reached. We're left with the question, how much wealth do we need to live wisely, agreeably, and well? How much wealth will suffice to get us off the growth treadmill? And to answer that, an economist needs to become a philosopher, and economics a philosophical as well as a mathematical project.
Yes, I mean, the contrast between Keynes as the economist of abundance, who can actually begin to theorize, think it worth theorizing, the consequences of abundance, is the basis, I think, of a really very, very interesting contrast with Smith. Smith is not dealing with a world in whose productive resources can be described in terms of abundance.
Back to this very interesting contrast between scarcity and abundance, the whole of classical economics was based on the idea of scarcity. I mean, that was its central root. All the logic flowed from that. And therefore the idea of abundance sort of never occurred. And it's interesting how, and Keynes, what Keynes did was to say, well, let's think about, not just in terms of utopia, but let's talk about a surplus of resources at various points rather than a scarcity of them. What sort of economics do you get out of that? And I mean, you got out of that, you got the general theory, as a matter of fact. What's happened today is that we've reverted to scarcity economics. I mean, Osborne is a classic scarcity economist. We don't have enough money to do these things. The fact that there is a rather large surplus of unused resources is not something, a thought that I think ever occurs to him. Or, if it does, they're not really surplus. In some way, we are at full employment, actually, in some way, and therefore we're in a world of scarcity. So you have this sort of break in economics, and now I think the dominant mood is austerity, scarcity, prudence, saving, back to the womb of saving, and out of this we will scramble out of the hole which extravagance has brought us into. A new classical economics fear behavioral economics, because it sort of opens up the whole story of human nature in a way that was closed down by the scarcity perspective and the self-interest, that sort of thread that comes out, I think comes out of Adam Smith. You see, I mean, I do love Adam Smith in a way, but I do think there were certain things he didn't do quite right. The family itself is not an independent unit. I mean, when Margaret Thatcher said they're only individuals and their families, you know, there's no such thing as society. Well, society is also a code word for community. But you can start from a different premise. And the fact is that the Chinese do start from a different premise, a different idea of human nature, a different idea of how individuals fit in to a structure. Different from Adam Smith. It seems to me, I don't know, I may be wrong about this, that Adam Smith starts with the individual and then derives a whole lot of relationships from the inescapable individual-ist premise. If you can't be an individual in isolation unless you're Robinson Crusoe. You live with other people. You form ways of living with other people which involve exchanges. It's a reciprocal thing. But then there's another, it's where you start from, and he started in a particular place, and I think it's a very valuable place to start from, but it's not the only place you can, and it doesn't give you, it doesn't explain everything about human nature. Keynes's rebellion against classical economics was Ricardo. He said Ricardo was the big wrong turning, in his view. Why exactly Ricardo was the wrong turning, I don't know, because the scarcity perspective, which Keynes really abandoned implicitly in his economics as a universal condition, was there in Smith, and Ricardo hardened it.
Anyone who says his aim in life is to make money invites the obvious question, what for? Money is for something. It's for something. Economists say neutrally that its purpose is to get us what we want. Moral philosophers say that its purpose, apart from satisfying our needs, is to enable us to live well. Now imagine a state of affairs in which goods are so abundant that no one needed to work. Most people would regard this as purely utopian. Yet it was exactly this prospect that Keynes conjured up in his little essay in 1930 called Economic Possibilities for Our Grandchildren. Keynes's thesis, in brief, was that capitalism was solving the economic problem. He reckoned that if capital accumulation and technical progress continued at their current rate, they would produce a 2% growth per year, and with population leveling off in 3 generations, roughly 100 years from 1930, we would all have a standard of living between 4 and 8 times as high as people did in 1930, obtainable at a small fraction of the effort. When this state of abundance had been reached, he thought that we might still want to work 3 hours a day, as he put it, to satisfy the old Adam in us. But otherwise we would be free to live like the biblical lilies of the field, that toil not, neither do they spin. Or more soberly, mankind would then come face to face with its permanent problem, which is how to live, I quote, how to live wisely, agreeably, and well. Keynes was here giving voice to the oldest of utopian dreams, of a society from which the burden of toil has been lifted. And he was saying that science and technology were bringing this about. Notice, though, that Keynes wasn't saying that X £1,000 was enough in some objective sense. He was simply suggesting that when people's income reached X, they would signal it was enough by giving up work. So how well has Keynes's projection of the future turned out? Let's take it on 2 dimensions, economic growth and hours of work. Keynes, it turns out, was a superb growth theorist well before growth theory became part of economics. For the developed world, his forecast of an annual 2% growth per year was a little conservative. In fact, the world has grown, or the developed world has grown by about 2.5% a year since 1950. But he was writing in 1930, at the beginning of, in the middle of the Depression. So it wasn't surprising that he was a bit more pessimistic than turned out to be the case. But broadly speaking, he was right. And this translates into the following growth rates per capita, this 2% growth a year. Could I have slide 1, please? And you can see that Keynes's forecast is in blue. The actual growth of the United States is very, very similar, and Europe, Western Europe, grew faster. Now, in the year 2007, UK per capita was £23,000, UK per capita income, between 4 and 5 times higher in real terms than in 1930. So we're well on target for an 8-fold increase in living standards by 2030. And that's despite the falsification of some of Keynes's assumptions, like there wouldn't be a major war and there wouldn't be population growth. So there he's fine, really. But what about the hours of work? Like all economists, Keynes treated work as a cost for getting a desired bundle of goods and services, and as productivity went up, this cost would come down. Therefore, people would work less. Here, Keynes's projections were less successful in a particular way, and could I have slide 2 to illustrate that? In 1870, people in Europe worked on average 3,000 hours a year, also in the United States. And that was the peak. It had actually gone up during the Industrial Revolution and then started to come down again from about 1870 onwards. By 1930, when Keynes wrote his essay, annual working hours were dispersed in a narrow range between 2,213 in the United Kingdom and 2,371. These are hours worked per year, per person. And they dropped by 30% by that time. After the Second World War, they kept dropping, but at a slower rate. Then from about 1990 onwards, they stopped falling, having roughly halved from 1870. In short, productivity, or output per hour of work, has gone up by much more than the fall in hours per person. You'd expect it to go up by somewhat more, but not by as much more. And today, average hours worked in the developed world, I'm talking about the United States and Europe, come to about 35 hours a week, and can't reasonably be expected to fall to 15 hours a week in 20 years' time, as Keynes thought they would. Americans and Japanese remain more workaholic than Europeans. And the result is even less impressive when one considers that there are many more women in the labor force than before. Women work on average fewer hours than men and would tend to bring down the average number of hours worked per person, even as it brings the total number of hours worked up. This slowdown and then breaking trend from 1919 onwards has called into question Keynes's vision of the inexorable passage to a workless future. So he leaves us with a question. Why have hours of work fallen less than he expected? Why have they stopped falling? What keeps our noses to the grindstone? Well, we can divide our explanation into 4 parts, and perhaps you could be kind enough to get slide 3 up. And I call these the intrinsic incentives to work, structural and cultural incentives to work, social incentives to work, and the last one, the insatiability of wants. Now, Keynes has been criticized, of course, for underestimating both the pleasure and moral attraction of work, and in particular the attractions of business life. He was notoriously he rated business rather low as a vocation, and so it suggested this influenced his views on the attractions of work. Well, the intrinsic satisfactions to be got from work are said to include the Promethean urge to improvement, the stimulation of new challenges, the pleasure of craftsmanship, and the sociability of the workplace. Hume pointed to people's intrinsic desire for liveliness. Because Keynes treated work as a cost, this is the way the criticism goes, he failed to recognize that technological progress was making work less unpleasant relative to leisure, and therefore would increase its attractions, relative attractions. And 2 writers have said that the trend Keynes failed to foresee was not to a state of worklessness, but to a state of joyful work. Work would become joyful. Technology would make it joyful.
The rosy idea that work is becoming more joyful has been challenged by those who argue that it is becoming less satisfying for the majority in recent years. Automation has robbed jobs of most of their craft and most of their sense of achievement, replacing them by largely meaningless service jobs. As for the majority, writes French sociologist André Gortz, work no longer signifies an activity or even a major occupation. It is merely a blank interval on the margins of life to be endured in order to earn a little money. Well, which view does one take? In our view, Keynes was right to stick to the traditional assumption of work as a cost incurred in order to obtain desired goods and services, and that, for the majority, such satisfactions as necessary work itself provides are incidental to this, even though work itself might be becoming less irksome. So I think that was the right view to take of the relationship between work and goods. Now I turn to the second, structural and cultural incentives to work. Textbook economics tells us that the choice between work and leisure is an individual one. If A works harder than B, it's because A prefers income to leisure and B prefers leisure to income. But this doesn't explain why Americans work harder than Europeans, even though the standards of living in the two societies are more or less the same. A recent survey pinpoints the difference between European and American attitudes. Asked whether they wanted to work longer hours, the same hours, or shorter hours, 21% of Americans said they wanted more hours, 42% the same hours, and 37% fewer hours. Asked the same question, 7% of Swedes only wanted longer hours, 31% the same hours, and 61% fewer hours. The Swedish attitude is replicated in surveys throughout Europe. Two obvious explanations for these differences present themselves. The first has to do with the structural characteristics of the labor markets in the two societies, and the second with something more nebulous, which we call culture. American economists, trying to explain why Europeans work less hard than Americans, assert that the Europeans suffer from a frustrated work preference. The European labour market is structured so as to limit the hours people can work, and this in turn limits the rate of growth. The contrary view is that Americans suffer from a frustrated leisure preference. Many would like to work less, but the character of the American labour market drives them to work longer than they would want to. Well, of course, you can make a case for both arguments. It's true that European labour legislation has limited the amount of hours worked. For example, Lionel Jospin introduced a 35-hour week into France, and there in Holland. You can point to and the European work directives and so on. Their tendency is to limit the amount of number of hours people can work. But is it true that a deregulated labour market gives a truer picture of people's preferences as between work and leisure than a regulated one? I don't think that case is at all made out. In 1993, the Harvard economist Juliet Shaw wrote a path-breaking book, The Overworked American, The Unexpected Decline of Leisure, in which she identified specific features of the American labor market which pressured Americans to overwork. And that's a very good book. And in her essay, Towards a New Politics of Consumption, Shaw makes the connection between frustrated leisure preference and exaggerated consumption. I'm going to quote a bit from that. The standard model, she writes, assumes that employees are free to vary their hours and that whatever combination of hours and income results represents the preferences of employees. But if employees lack the opportunity to vary their working hours or to use improvements in productivity to reduce their work time, then we can in no way assume that the trajectory of consumption reflects people's preferences. There may well be a path for the economy that involves less work and less stuff, and is preferred by people to the high work, high consumption track. But if that option is blocked, then the fact that we can spend a lot can no longer be taken ipso facto as proof of our inherent consumer desires. We may simply be doing what is on offer. Well, you know, when you talk about labour market institutions, they're quite hard to divorce from the general culture of the society. Well, one economist, Axel Lenhufud, has noted, you may say this is anecdotal, but you know, it can be done. You know, surveys often tell us what we already know, don't they? Italians have less female labour force participation, work fewer hours, take longer vacations, retire earlier than their American counterparts. They also enjoy their food and the talk that comes with it more. By contrast, American workaholism, you could say, is based on the culture of immigrants. It's more achievement-oriented, with consumption as confirmation of success. In the jargon, American history has given Americans an endogenous preference towards consumption, and the Europeans an endogenous preference towards leisure. However, survey evidence suggests that the Americans are less happy with their work-treasure trade-off than many American economists believe. But how much can culture explain? Before the 1960s, the United States was among the developed countries with the shortest working hours. Unless there's some argument to make about a reversal in culture, which might be associated with the Reagan-Thatcher revolutions, cultural arguments can't do the work that is needed to explain their longer working hours, because they didn't used to be longer. Now, let's take social incentives to work. Transcending particular labour markets and cultural biases, social changes since Keynes's day have tended to keep up the hours of work in ways he didn't anticipate. The chief of these are increasing longevity, increasing inequality, and the increasing cost of leisure itself. People in most of the world live on average 20 years longer than they used to, than they did in Keynes's day. In Western Europe, the old age dependency ratio has gone up from 18% in 1960 to 28% in 2010, and it's projected to reach 51% by 2050. The increasing gap between work and death, known as retirement, means that people must work harder to support themselves in old age. Put another way, the income Keynes would have deemed enough now has to be spread over an extra 20 years to cover the additional and increasing years of productive inactivity, not to mention the increasing cost in terms of medical advances and treatment of prolonging life, the demand for which seems to be insatiable. A second factor keeping up the pressure for work is surely the increase in inequality. Keynes's projection was of average income per capita. This has indeed risen in line with productivity, but the fruits of the gains in productivity have gone increasingly to owners of capital, especially since the 1980s. This has postponed the coming of abundance for the majority. Could I have the next slide, please? Which is a Gini coefficient, and it plots the increase in inequality, the higher the percentage, the greater the inequality, since 1977. And you can see in America it's gone up. The biggest increase in inequality in both the UK and the United States took place roughly from 1980 to 1991. And then in America it went on going up. In Britain it sort of tended to flatten out. And then in Europe, you can see, we haven't got all the data here, but you can see it also had a tendency to rise. And, you know, you can show exactly what happened to shares of income. And basically, the top quintile just got more and more, and the remaining ones didn't get less and less, but they didn't go up nearly in proportion. Then could we show the British case? Please, in the next slide. And this is the Gini coefficient for Britain. Now, it's the highest, the inequality is higher in Britain than in any other non-ex-communist European Union country. The ex-communist countries have special features. But here, it's 34%, whereas the average in non-communist, non-ex-communist Europe is 28%. Then, if we then take the next slide, fifth slide, this shows the difference between average and median income, or GDP, over this period of time. Median wages for American males in their 30s were lower in 2004 than they were in 1974. God, I hope the graph shows that. Probably doesn't. No, it doesn't. Why have I got that down? But anyway, what you can see is that there's a very, very slow growth in median incomes, and in fact, even a slight fall at the beginning years of this century, whereas average income keeps going up. Median wages for American males in their 30s were lower in 2004 than they were in 1974. Real wages for most Americans have stagnated since the 1980s, and the vast majority of American households can scarcely make their ends meet. Now, to summarize this strand of the argument, the huge expansion of wealth at the top of the income scale has boosted the per capita GDP of contemporary societies, but depressed their median incomes. And this has gone together with growing insecurity of employment and the increase in unemployment and part-time employment, not as a result of voluntary choice for more leisure, but as a result of a decline in the number of available jobs. Now, there's an important implication of this. The more unequal societies are, the more likely they are to experience a positional competition for relative gains. There's another interesting implication. Advanced countries with higher inequality exhibit greater hours worked and a greater desire by the population to work more hours. In other words, the higher the Gini coefficient, the more the annual hours worked. And that brings us to my last slide, please. You can see there's a significant correlation between hours worked and the rise in Gini coefficient. A third reason for the failure of hours to fall is less obvious. Improved technology doesn't only raise the productivity of production, but also raises the cost of leisure. Although their cost has been falling, a plethora of technically sophisticated goods are being produced that require more money than time to be enjoyed. Most traditional leisure didn't involve nearly as much consumption relative to income as it does now. Income was spent on basics, with a fringe left over for leisure. In other words, people entertained themselves much more. So technology has determined the form which leisure takes, and the form leisure takes influences the number of hours worked. Well, what we've been saying so far is that most people continue to work longer hours than Keynes expected because they have not, in fact, achieved their consumption goals. They are compelled by circumstances to work to realize the expectations which are continually being disappointed. But that's not the same as saying that their consumption goals are insatiable, only that Keynes's utopia has been postponed. However, we now come to the possibility that his utopia is unobtainable within his own framework because wants are insatiable. Keynes thought that as our consumption is satiated, we'll work less. The flat line of hours worked since 1980s seems to refute this. We can't assume that all workers in our society have a frustrated leisure preference. Some seem happy working longer hours for higher salaries. Why is this? Well, psychological explanations of the barrier to the fall in hours claim that people work as hard as they do because they want to. This leads us to inquire into the origin of this want. According to the psychological account, what keeps people working is not the remediable frustration of limited wants, but the delusive nature of insatiable wants. And there are a number of different forms of insatiability, and they should be distinguished. First, a repeated experience gives diminishing pleasure. Hence, there is a continual quest for new experience. Keynes assumes stable consumption demands, but while satiation might occur for a given type of product, the sheer mass of new products create new desires and new demands, requiring increased doses of human effort. This form of insatiability doesn't depend on interpersonal comparisons. Robinson Crusoe might experience it. It's the rising demand for quality that's insatiable, itself a product of rising incomes. Second source of insatiability. Individuals' sense of well-being depends not on their absolute level of consumption, but on their consumption relative to others. This gives rise to the rat race. They get more goods but get no happier, since everyone is getting richer as well. Keynes himself recognized that needs were of two kinds, absolute and relative, and that the latter might be insatiable. But he underestimated the weight of the relative needs. In fact, he mentioned them and never referred to them again in his argument. The three main examples of relative demands for consumption are the bandwagon effect, the snob effect, and the Veblen effect. The bandwagon effect depends on the fact that others have the goods one wants. The snob effect depends on the fact that others don't have them. And the Veblen effect on the fact that they're expensive and known to be expensive. Together, these effects produce an infinite escalation. The perceptions involved don't have to be conscious, and in fact, they operate unconsciously. Advertising inflames all three. There's a page in the magazine The Week. I don't know whether you read The Week. The Guardian, I think, is responsible for producing it, which suggests gifts for those who have everything. For example, for £295, you can buy a fun 3D alphabet for your kiddies, with Granny popping out at the letter G, and so on. The production of unnecessary commodities, which give a moment's pleasure before becoming rubbish, is an important mainstay of our economy. Under the extreme version of the relative consumption hypothesis, where well-being depends only on one's relative consumption, increases in incomes have no effect on leisure, since higher incomes don't increase the psychological sense of well-being. And third, the demand for income might well be insatiable, even if demand for goods isn't. This is due to the existence of positional goods in Fred Hirsch's original sense. Fred Hirsch was my predecessor as professor of international relations at Warwick. He died tragically young, but he wrote a very important book in which he developed, really originated the concept of positional goods, which can't, by their nature, they're absolutely scarce. And these aren't to be confused with snob, bandwagon, or Veblen goods. They're not goods, the demand for which is relative to the consumption of others. And so there are other things, other kinds of insatiable demands for earned income, insatiable demand for goods, which you know, you can go through and you sort of feel that if you're dealing purely with the world of wants, that there's no way of limiting them. And money is another huge cause of the overshooting of wants. As the Bible recognized, the love of money is the root of all evil. This is because the existence of money strengthens the desire for abstract gain at the expense of the desire for concrete enjoyment. Keynes wrote, "We ought more often to be in a state of mind, as it were, of not counting the money cost at all. We want to diminish rather than increase the area of monetary comparisons." Since Keynes's day, the tendency has been the opposite of what he wanted. In the hugely expanded financial services sector of today, money makes money by buying and selling nothing but itself. So I reach my conclusion. If wants are in fact insatiable, what chance have we got of getting off the growth treadmill? The starting point of any answer to that kind of question is surely to distinguish between wants and needs. Wants may be insatiable, but not all needs are. Stiglitz believes that the American system has created an insatiable set of wants, which ensures that the economic problem will never be solved, so that matters of greater and more permanent significance will continue to be sacrificed on its altar. Similarly, Shaw believes that the insatiability of wants is the artifact of a particular kind of economic civilization, one that produces an ever-escalating consumption norm. But this is because the adequacy of wants is analyzed on the basis of human desire rather than human need. The state exploits the insatiability of wants because it can offer its citizens nothing better than more stuff. Quantity of stuff replaces quality of life. Without a different framework for understanding what is enough, all attempts to achieve adequacy or enoughness will be self-defeating. Thus, while insatiability may explain our continued addiction to work, it doesn't justify it, since it is itself irrational. We should not be cowed by the orthodox veto on passing judgment on wants. If our problem lies not simply in the frustration of wants, but in the socially produced wants themselves, then it's not amenable to straightforward legislative solution. What is required is a change of values, a revival of the idea of the good life. What this might involve and what it should reject is the subject of our book and of Edward's lecture. Thank you.
In post-war years, Hayek came to be revered as a philosopher of freedom, but marginalized as an economist, because he lacked both a model and a policy. I just want to conclude by looking at this debate in the light of what's happened in the last 2 or 3 years. Because it's resurfaced again. These traditions are the only ones that have anything really interesting to say about the causes of the recent Great Recession. For those who believe that the market economy is adequately self-regulating, a collapse of the kind we have just experienced must be due to exogenous shocks, and this is the setting for the money glut explanation. On the other hand, the alternative saving glut theory of the slump is derived from the Keynesian view that slumps are caused by saving running ahead of investment. So you have this sort of replay, in a way, of these explanations. There's a sense in which Hayek and Keynes are closer to each other than either are to the new classical economics, which has for so long been mainstream, and that's because they both recognize the crucial importance of money. They both rejected a method of theorizing which ignored the role of money, banks, credit risks, defaults, and so on. Admittedly, they explained the role of money in different ways. For Hayek, it remained essentially a disturbing force in an otherwise smoothly adjusting barter-type system, whereas for Keynes, it was the store value function of money which was key, based on the existence of inescapable uncertainty, and that explained the instability of investment, liquidity preference, and their consequences for the equilibrium of the real economy. I just want to say a last word. It's often said that a Hayekian approach sheds more light on the recent financial collapse than a Keynesian one. This is true in one respect. Hayek would not have thought that price stability indicated a lack of inflationary tendencies, and that's a central proposition in his theory. Therefore, he would have been more alert than recent monetary managers have been to the build-up of unsustainable asset bubbles. But on the other hand, I find it difficult to characterize the housing bubble and concomitant debt-fueled consumption as an example of Hayekian malinvestment, since they did not involve investment in intermediate goods. Absence of uncertainty is the big lacuna in Hayek's system. Things can go wrong because credit creation fools investors about the risks they run, not because they face a genuine unknown. And here I would say Keynes's distinction between risk, which is measurable, and uncertainty, which is not, is crucial to his economic understanding and distinguishes it most sharply from the conventional view that recent banking collapse was caused by the mispricing of risks. Nevertheless, in attacking the current method of doing economics, Hayek and Keynes would have been in the same camp. But Keynes would have gone on to say that we need to develop a model of the modern macroeconomy which takes uncertainty seriously, and therefore I believe that his was the more radical critique. Thank you.